Most people think that itemizing deductions is only for the people who are good at taxes. So they don't even consider it. They just take the easiest option, check the box for the standard deduction, and move on. And here's the truth. This decision has nothing to do with being good at taxes. It's a simple math question. Is the number the IRS gives you bigger or smaller than your real-life expenses? That's it. If your actual costs, like a mortgage, state taxes, medical bills, or donations, are higher than the IRS's flat number, and you still take the standard deduction, you're giving up money. Not because you made a mistake, just because you didn't compare the numbers. So in this video, we're breaking this down in plain English. No jargons, no tax tricks, just how this decision actually works, and how to know which side saves you more money. Let's start with the option most people use by default. The standard deduction lets you reduce your taxable income by a set amount, without the hassle of keeping receipts or itemizing expenses. It's the safety net. You don't have to prove anything. You don't have to list expenses. You don't have to keep detailed records. Instead, you just take the number and move on. For 2026, that number depends on how you file. If you're single, the standard deduction is $16,100. If you're married filing jointly, it jumps to $32,200. If you file as head of household, it's $24,150. And if you're married filing separately, it's back to $16,100. Now here's why this exists. The IRS designed the standard deduction to simplify taxes for the majority of people. If you rent instead of owning a home, if you don't have large medical bills, if you don't make big charitable donations, or if your life is financially straightforward, the standard deduction usually works in your favor. It's fast, it's simple, and it removes the burden of tracking every expense all year long. And for many people, that's exactly what they want. Now, quick but important reminder. The standard deduction amount changes over time due to inflation and tax law updates, so always check the current year's IRS limits before filing. Now here's the key point most people miss. The standard deduction is not the best option. It's the default option. It's designed to be good enough for most situations, not optimized for every situation. And the moment your real-life expenses start stacking up, this flat number may stop working in your favor. That's when the other option starts to matter. This is where people tend to lose interest, because itemized deductions sound complicated. But the idea itself is actually simple. Instead of taking one flat number from the IRS, you build your own deduction based on the expenses you actually paid during the year. You're choosing to skip the default amount and use your actual expenses instead. This is done using Schedule A. Now this only makes sense when certain expenses are high. And for most people who itemize, those expenses usually fall into a few major buckets. The first big one is homeownership. If you own a home, mortgage interest can add up quickly. On top of that, you have property taxes. For homeowners, this category alone can sometimes get very close to the standard deduction. The second category is state and local taxes, often called SALT. This includes things like state income taxes or sales taxes you paid during the year. Depending on where you live, this can be a significant number. The third category is charitable donations. This includes donations to qualified nonprofit organizations, things like charities to registered 501c3. If you give donations consistently or make a large one-time donation, this category can push your total higher than you expect. The fourth major category is medical expenses. This one surprises a lot of people. You can only deduct the portion of medical expenses that exceeds a certain percentage of your income. So smaller expenses usually don't count, but major medical events absolutely can. Now, a quick but important reminder here. Each of these categories has its own limits and rules, which can change over time, so the exact amounts and thresholds may differ by tax year. That's why itemizing isn't about guessing. It's about adding up what actually applies to you. If none of these categories are large, itemizing usually doesn't make sense. But if even one of them starts getting big, the math changes fast. The essential part is understanding the break-even point, and this is the part most people completely misunderstand. I want you to picture this very simply. Think of a balance scale. On the left side, you have the standard deduction. That's a fixed number. It doesn't care about your habits, your bills, or your life. It's just there. On the right side, you have all your itemized deductions added together. Things like mortgage interest, state and local taxes, charitable donations, medical expenses that qualify, and so on. Now here's the rule that actually matters. If the right side is even $1 higher than the standard deduction, itemizing usually saves you money. Not by magic, not by loopholes, just by basic math. But if the right side is lower, even by a small amount, then the standard deduction wins, and it wins for two reasons. First, you pay less tax. Second, you save yourself a lot of paperwork and stress. Itemizing isn't automatically better. It only makes sense once your deductions pass the break-even point. Before that point, you're just creating extra work for no benefit. And here's the important strategy to follow. You don't decide this emotionally. You don't decide it based on what you did last year. You decide it by adding up the numbers and comparing them. That's it. Winning here isn't about choosing itemized or standard. Winning here is choosing the option that gives the lower taxable income. Sometimes that's itemizing. Very often it's the standard deduction. Once you understand this break-even concept, the decision stops being confusing and starts being obvious. Now let's talk about a couple of rules that don't get discussed much but can completely change the outcome. First, let's talk about filing status, because this one surprises a lot of people. If you're married and filing separately, you don't get full freedom here. If one spouse itemizes, the other spouse has to itemize too, even if they don't have a single deductible expense. There's no mixing and matching. So if one person has mortgage interest or large deductions, and the other doesn't, the second person can lose the standard deduction entirely. That's why, for many couples, married filing separately ends up costing more, unless there's a very specific reason to use it. Now here's the second rule, and this one usually works in your favor. Some deductions happen before this decision even comes up. Things like student loan interest or certain work-related adjustments reduce your income first, and then you choose between standard or itemized deductions after that. So choosing the standard deduction does not mean you're giving up every tax break available. You're only choosing how to handle one specific part of the return. This is important because people often overthink this choice. They assume it's all or nothing, either simple or complex. In reality, it's just one decision inside a much bigger process. And understanding where that decision fits is what keeps you away from making an expensive mistake. So let's bring this together. The standard deduction is about speed and simplicity. It's designed for people with straightforward finances who don't want to track every dollar. On the other hand, itemized deduction is for specific life situations. Buying a home, paying large medical bills, or having high state taxes can push your real expenses past that flat IRS number. Neither option is better by default. One just wins the math. So here's the action step. And this matters. Don't guess. Pull one real document. Your mortgage statement, your property tax bill, or your medical expenses for the year. If just one category already gets close to the standard deduction, that's your signal to slow down and do the math before filing. Because when it comes to deductions, the IRS isn't asking you to be smart, they're asking you to be accurate. And accuracy is what keeps more money in your pocket. If this breakdown helped you understand the concept more clearly, consider subscribing to the channel. I'll see you in the next one.